We have just witnessed one of the most violent trading sessions in the history of the precious metals market. If you are looking at your screen right now, you are seeing an ocean of red. You are seeing a level of volatility that can make even seasoned traders sweat and algorithms fail. The price of silver has collapsed. We are trading at $72.75, down $6.50 in a single session. That is a decline of over 8%. But it's not just silver. Gold has been hammered. Gold is trading at $4,378, down $156. That is a 3.5% drop for what is traditionally considered the most stable asset in the world. When gold and silver crash together, moving in unison with a ferocity that defies logic, you are not witnessing a mere market correction. You are looking at a liquidity crisis. This is the moment when the financial system screams for cash. It is the point where funds, banks, and institutions stop caring about value and start worrying about survival. They are not selling silver because they hate silver. They are selling it because it is the only liquid asset available to meet immediate obligations. In this emergency market analysis, we will dissect this crash with surgical precision. We will explain why a drop in gold is actually one of the most terrifying signals for the broader financial system. We will look at the mechanics of a margin cascade, how the collapse of one fund can trigger a chain reaction that drags down every asset class. We will examine the history of liquidity crises from 2008 to 2020 to understand what usually happens after such a crash. Does the price recover, or is this the start of a deflationary winter? This is not advice to buy the dip or to sell and run. It is about understanding the mechanics of the machine that is currently devouring wealth. Knowing why the price is falling is the only way to keep your head while everyone else is losing theirs. To understand why silver fell 8%, we must look at the principle of selling what you can, not what you want. This is the golden rule during a margin call. Imagine a massive hedge fund. We'll call it Fund X. Fund X is long stocks, long bonds, long gold, and silver. Suddenly, the bond market turns against them, or a currency trade blows up. Their broker calls and says, "You owe $5 billion in cash by the end of the day." Fund X scans its portfolio. Bonds are illiquid and falling. Private equity cannot be sold quickly, but gold and silver, those are liquid. They have a global buyer base and trade 24 hours a day. So Fund 10 hits the sell button, dumping billions of dollars of precious metals in a single second. They don't want to sell. They love gold. They think silver could hit $100, but they must sell to preserve the rest of their portfolio. This is what happened today. The $156 drop in gold is the smoking gun. Retail traders don't sell gold like that. Only a distressed institution does. The shockwave then hit the silver market. Silver is smaller than gold. So when liquidity evaporates, silver falls harder. Gold falls 3%, silver falls 8%. That is the beta, the volatility multiplier. It is painful and ugly, but it is not a reflection of silver's fundamentals. Industrial demand remains. Samsung still needs batteries. Solar farms still need paste. The financial liquidity is what evaporated. We also need to consider the dollar index. Typically, when commodities crash, the dollar spikes. In a liquidity crisis, the US dollar behaves like a wrecking ball. When banks are frightened, they hoard dollars, stop lending, sell foreign assets, and buy cash. This strengthens the dollar. Silver is priced in dollars. So when the dollar rises, silver falls further. We are likely witnessing a massive spike in the DXY right now. It's the flight to safety. Ironically, the short-term safety is the fiat currency that caused the problem in the first place. Investors sell the lifeboat to climb aboard the Titanic, choosing cash while ignoring broader risk. This dynamic produces a deflationary shock. Prices across stocks, crypto, oil, and silver all fall. Only cash rises in purchasing power. This environment is extremely dangerous for leveraged investors. If you borrowed money to buy silver, an $11 swing wipes out your equity. Brokers automatically liquidate positions to recover funds, leaving the trader empty. And historically, once the liquidity crisis passes, the central bank injects liquidity and silver usually surges. But if you are forced to sell at the bottom, you miss the rally. This is why leverage is so perilous. $83 seems secure this morning. $72 looks catastrophic this evening. The psychology of the trap is clear. This morning at $83, the market enticed retail traders. It looked like a breakout. They bought thinking the price would soar to $100. Then the liquidity event struck. Heavy selling began. The price fell through $80, $78, $75. Stop losses triggered, compounding the fire. Now traders sit at $72 asking if they should sell to preserve what's left. This is capitulation. When bulls surrender hope, that often signals a bottom, but in a liquidity crisis, the bottom can still be lower. Markets care about cash flow, not fair value. Compare this to March 2020. The pandemic caused silver to crash from $18 to $12 in 1 week, a 30% decline. Demand didn't vanish. The world needed dollars. Hedge funds sold silver to cover losses in stocks. But the Fed stepped in, printing $3 trillion, and silver soared to $30 in 5 months. Today's numbers are larger, $72 instead of $12, but the mechanism is identical. Valuable assets are being sold to save other positions. So, what is the responsible approach? Exercise caution, avoid chasing a falling knife. An 8% daily drop creates structural damage, support levels break, sentiment shatters. Silver may retest $70 or even $68. Volatility clusters, big moves beget more big moves. If you hold physical silver, your strategy is simple. Do nothing. The coins and bars in your possession haven't changed. The paper market has crashed, but the physical market remains tight. Dealers maintain premiums. Scarcity hasn't disappeared. Spot may read $72, but generic rounds might sell for $82, a $10 premium. That premium signals that supply chains are broken, not that the metal has lost value. Don't panic, mining stocks, meanwhile, have been hit hard. First Majestic, Hecla, Pan American likely lost 10 to 15%. Investors panic, but their underlying cash flow remains strong. Costs are still $20 per ounce. Profits, $50 per ounce. A one-day stock drop doesn't erase that. Stocks are emotionally punished, but the fundamentals remain intact. For disciplined investors, this creates a coiled spring ready for a rebound once the market stays. Looking at history, liquidity crises are brief but intense. 2008's acute phase lasted about a month. 2020's lasted 2 weeks. The system cannot endure prolonged deflation without systemic failure. Central banks respond quickly. Expect a few days of turbulence, then a V-shaped recovery. Silver could fall to $70 one day and rebound to $80 within days. Perspective is critical. On December 1st, silver was $60. Even after today's violent drop, $1.72 is still a 20% gain in less than a month. The market anchored to the high at $83, but the trend remains upward. Higher highs, higher lows. Panic today signals a contrariness opportunity. The weak hands have been flushed. The market is lighter, cleaner, and ready for the next rally. As we continue this analysis, the focus must shift deeper into the gold collapse, because while silver traders are staring at a $6 drop, global macro investors are fixated on gold. Gold falling by $156 in a single session is not normal behavior. This is a 3.5% move in an asset with a market capitalization north of $15 trillion. To put that into perspective, that's like erasing the entire market value of a mega-cap tech company in a matter of hours. This tells us something critical. The stress in the system is not isolated, it is global, and it is systemic. When gold is sold this aggressively, it means high collateral is being liquidated. In the hierarchy of money, gold sits near the top. It is the asset that gets sold only when everything else has already failed. It is the emergency reserve. When gold is dumped, it means someone is in real trouble. So who is selling? The answer likely points back to the bond market. We are seeing signs of rising yields and falling bond prices. Bonds are the backbone of the financial system. They are used as collateral for loans across banks and institutions. When bond prices fall, the value of that collateral drops, triggering margin calls. When those margin calls arrive, borrowers must raise cash immediately. If they don't have cash, they sell what they can. That often means gold. When gold is sold, algorithms instantly respond by selling silver because the two trade as a correlated pair. This is the contagion pathway. Silver is not falling because of its own market conditions. It is being dragged down by leverage stress elsewhere in the system. This is frustrating for silver investors because the fundamentals remain intact. Industrial demand hasn't disappeared, but leverage does not care about fundamentals. This is also why liquidity crises tend to be short. The Federal Reserve cannot allow the bond market to spiral out of control. If bans fail, governments cannot finance themselves. If collateral chains break, banks fail. So the response is almost always the same. Liquidity is injected, emergency facilities are opened, money is printed. In 2008, rates were slashed. In 2020, trillions were created out of thin air. When that liquidity enters the system, it flows directly back into the assets that were sold unfairly. Gold and silver are usually first in line. This is why the crash is often the setup for the next explosive rally. We are currently in the pain phase of that cycle. We also need to talk about algorithmic trading and how it magnifies moves like this. Modern markets are dominated by trend-following funds and CTAs. For weeks, the trend was higher. The models were long. They were programmed to buy dips, and they helped drive silver toward $83. But today's drop was violent enough to break key technical thresholds. Once those levels broke, the algorithms flipped, long positions were closed, and in many cases, new short positions were opened. This selling is mechanical. It is not emotional. It does not understand supply shortages or industrial demand. It simply reacts to price and momentum. This creates overshoots. Prices fall far below where fundamentals would justify. That is the opportunity for human investors who understand the physical reality of the market. Eventually, the selling stops when physical buyers step in. This brings us to the concept of the physical floor. We already know that Asian markets, particularly China, have been paying significantly higher prices for silver. If silver is trading at $72 in New York while buyers elsewhere are paying closer to $80, the arbitrage opportunity becomes enormous. That price gap acts like a rubber band. The wider it stretches, the stronger the snap. Unless global demand collapses simultaneously, the physical market will absorb the excess paper supply. In fact, price crashes in Western paper markets often accelerate the drain of physical metal to the east. Cheap silver doesn't stay cheap for long when real buyers are waiting. Now, consider the chart structure. Technically, today produced a massive bearish engulfing candle. Many traders will interpret this as a major top and rush to short the market. This invites further downside pressure. Bears feel confident after a day like today, but history shows that in secular bull markets, these patterns often fail. They turn into traps. If the price stabilizes and refuses to fall further, short sellers become nervous. Their covering becomes fuel for the next rally. What we are witnessing now is redistribution. Ownership is shifting from leveraged speculators to stronger hands. End users, industrial buyers, and long-term holders don't trade in and out. They remove supply from the market. That tightening eventually asserts itself. Dealer premiums tell the real story. Anyone watching the physical market knows that premiums remain elevated. Spot prices can fall, but if dealers cannot restock inventory cheaply, retail prices don't follow spot lower. This divergence is a warning sign that the paper price has detached from reality. If you attempted to sell physical silver today, many dealers would still offer prices above spot because they need inventory. That means the loss shown on a chart is not the loss experienced in the real market. The paper market crashed. The physical market barely blinked. This crash also reshapes the setup going into January. Rather than destroying the January effect, it may strengthen it. Entering the new year at $72 instead of $85 makes silver look attractive to institutional money. Pension funds and asset managers prefer buying pullbacks, not chasing breakouts. This correction washed out excess leverage and reset sentiment, creating a cleaner entry point. It would not be surprising to see strong inflows once liquidity returns after the holidays. Tax considerations also matter. With year-end approaching, many funds sell losing positions to realize tax losses. That creates artificial selling pressure that disappears once the calendar flips. January often marks a reversal because the forced sellers are gone. The supply of sellers dries up, but demand remains. So how long does this last? Liquidity crises are violent but brief. They tend to resolve within days or weeks, not months. The system simply cannot tolerate prolonged deflation. Central banks act quickly. Once confidence stabilizes and liquidity returns, rebounds can be just as sharp as the collapse. Silver falling 8% in a day means it can rise 8% just as fast. Volatility cuts both ways. Psychologically, this is the hardest moment. Anchoring bias makes losses feel worse because traders saw higher prices recently, but zooming out changes the perspective. Silver is still dramatically higher than it was a month ago. The trend remains intact on higher. One brutal correction does not erase months of progress. Panic is usually a signal that a bottom is forming, not that a bull market is ending. Geopolitical risks have not vanished either. Global tensions remain high. Any unexpected headline can instantly reverse market sentiment. Liquidity crises cause markets to temporarily ignore real-world risks, but those risks don't disappear. Silver remains a hedge against instability, not something to abandon when instability appears. Short sellers may feel victorious today, but greed often traps them. Many will press their bets, expecting further downside. If the market stabilizes and turns higher, those shorts will be forced to cover, adding fuel to the recovery. This cycle has repeated many times before. For physical holders, today changed nothing. The ounces you own are the same ounces you owned yesterday. Fiat prices fluctuate because fiat itself is unstable. Allowing distressed sellers to dictate your perception of value is a mistake. Time favors the patient, not the leveraged. This crash was not the end. It was a clearing event. Leverage was flushed. Sentiment was reset. Ownership is shifting to stronger hands. Liquidity crises always feel like the end of the world in the moment, but history shows they are often the beginning of the next phase. The destination hasn't changed. The path just became more volatile.